Welcome back to Islamic Finance Unboxed, your go-to channel for breaking down the principles, tools, and innovations of faith-based finance. In today's episode, we explore Wakalah, a fundamental Islamic financial concept built on the principle of trust and agency. But what is Wakalah exactly? How is it different from other Islamic contracts like Mudarabah or Musharaka? And how is it used in today's Islamic banking world? Let's dive in. What is Wakalah? Wakalah is fundamentally an agency contract. In Arabic, Wakil means agent or representative, and Wakalah refers to the act of delegation. In the context of Islamic finance, Wakalah is a contract whereby one party, the principal, appoints another party, the agent, to carry out a specific task or transaction on their behalf. This could involve investment management, trade deals, or even administrative duties such as paying bills or collecting payments. The fundamental principle of Wakalah is based on trust. The agent is duty-bound to act in the best interests of the principal and must refrain from any actions that would be considered a violation of Islamic ethical norms. Consider it on a par with hiring a lawyer, real estate agent, or financial advisor, but within a Shariah-Compliant framework. How does Wakalah work? To illustrate this point, let us consider a simple example. If you are interested in investing your money but do not have the time or expertise, we can help. You appoint a bank or financial expert to act as your agent and invest your money on your behalf. You provide the capital, and they carry out the agreed actions, such as trading in halal equities. As the principal, you are responsible for the risk of the investment, not the agent. If the investment generates a profit, it is yours to retain. Should the outcome result in a loss, the agent will not be held liable, provided that the loss is not due to negligence. However, if the agent is careless or violates the agreement, they may be held accountable. The Wakil generally receives a pre-agreed fee, irrespective of the investment outcome. It is imperative that this fee is both fixed and transparent, in order to avoid any ambiguity, a crucial aspect of Islamic contracts. Key features of Wakalah. Here are the main pillars that define a valid Wakalah contract under Islamic law. Offer and acceptance. The contract must have a clear and mutual agreement. Define task. The agent's responsibility must be specific, such as buying goods, managing investments, or collecting zakat. Clear fee structure. The agent may act voluntarily or for a fee, but if there is compensation, it must be clear and known upfront. Termination. Either party can end the contract at any time unless it's a binding contract with conditions. No guarantee of profit. The agent doesn't guarantee a profit or cover losses unless due to misconduct. This model promotes transparency, honesty, and risk-sharing, all foundational principles in Islamic finance. Applications in modern Islamic banking. Wakalah isn't just a theoretical concept. It's widely used in contemporary Islamic finance. Let's look at how. 1. Investment accounts, Wakalah by Al-Istithmar. Many Islamic banks offer Wakalah-based investment accounts, especially for wealth management clients. The investor gives the bank authority to invest funds in Shariah-compliant avenues. The bank charges a management fee for its services. Unlike Mudarabah, where profit sharing is agreed upon, Wakalah focuses on agency and fixed fees, making it appealing for investors who want more predictability. 2. Takaful, Islamic insurance. Takaful operators often work as Wakil on behalf of participants. They manage the Takaful fund and take a fee from the contributions. This model is seen as more transparent than the Mudarabah-based structure. 3. Trade and procurement. In import-export scenarios, a buyer may appoint a bank as their Wakil to handle logistics and payment. The bank acts on behalf of the customer to complete halal trade deals efficiently. Wakalah versus Mudarabah versus Musharaka. Now, let's take a moment to understand how Wakalah differs from some other major Islamic financial contracts, Mudarabah and Musharaka. Imagine you're planning to grow your wealth in a Shariah-compliant way. You're presented with three options, Wakalah, Mudarabah, and Musharaka. At first glance, they may seem similar. They all avoid interest and promote fairness, but each follows a different financial logic. In Wakalah, you act as the principal. You appoint someone, a bank or an individual, to act on your behalf. You give them clear instructions and full authority to carry out a task, such as investing in halal stocks or managing a business deal. This person is your Wakil, your agent. They earn a fixed fee, agreed upon upfront, no matter how the investment performs. If the venture succeeds, the profits are all yours. If it fails, and the agent did everything correctly, you bear the loss. In other words, Wakalah is all about trust and responsible representation, where the financial risk stays with you, the principal. Now let's compare that with Mudarabah. Here, the roles shift. You, as the investor, provide the capital, while another party, the entrepreneur or bank, offers their expertise and labor. Profits, if any, are shared between both parties based on a pre-agreed ratio. However, any financial loss falls entirely on the investor unless the manager was negligent or dishonest. Mudarabah is less about fixed fees and more about risk-sharing partnerships where rewards and losses are tied to performance. Then we have Murabahah, which is fundamentally different. Murabahah is not about representation or partnership. It's a trade contract. Let's say you want to buy a car, but you don't have the full amount up front. A bank purchases the car for you and then sells it to you at a markup, disclosing the cost and the profit margin. You pay in installments. There's no agency here. The bank takes ownership of the product temporarily and then transfers it to you with a profit included. Murabahah is about clarity and transparency in trade, where the profit is known, fixed, and agreed upon in advance. So, to wrap it up in simple terms, Wakalah is about delegating authority, Mudarabah is about sharing profit and risk, and Murabahah is about buying and selling with transparency. Each has its own role in the Islamic financial system, and depending on your needs, whether you're looking for trust-based agency, performance-based partnership, or structured trade, there's a tool that fits. Pros and cons of Wakalah. Advantages. Simplicity, easy to structure and understand. Flexibility can be applied across various industries. Transparency, fixed fees remove profit ambiguity. Legal alignment, close to conventional agency law. Disadvantages. Principal risk, the investor bears all financial risk. No profit guarantee. Unlike profit-sharing models, the return isn't linked to performance. Moral hazard, if the agent is negligent or unethical, it may harm the principal. Hence, clear monitoring, reporting, and Shariah supervision are essential to make Wakalah contracts effective and ethical. Controversies and modern debates. Though Wakalah is generally accepted, there are some debates among scholars and practitioners. For example, is it permissible to tie the agent's performance to a bonus based on profits? Some scholars allow conditional incentives as long as the base fee is fixed. Can Wakalah be combined with other contracts like Ijara or Mudarabah? Yes, in practice, hybrid models are emerging, such as Wakalah Mudarabah funds and Islamic asset management. Another discussion concerns transparency in disclosing risk and cost to investors, especially in wealth management. Some institutions may blur the lines between advisory and responsibility. Real-world case study. Let's look at a real-world example. Dubai Islamic Bank offers investment products based on Wakalah by Al-Istithmar, where clients delegate investment responsibility to the bank in exchange for a fixed agency fee. These products offer projected returns, but clients are informed that returns are not guaranteed. This model aligns with both Shariah values and client preferences, a good balance of faith and finance. Wakalah is a brilliant example of how Islamic finance prioritizes ethics, transparency, and fairness, all while allowing modern functionality. It proves that trust and business can coexist in today's complex financial world. If you enjoyed this breakdown and want more tools demystified, from Takaful to Sukuk to Ijara, don't forget to like, subscribe, and share this video. Drop your questions or country-specific experiences in the comments. We love hearing your thoughts. Until next time, this is Islamic Finance Unboxed. Exploring the future of finance through a faith-conscious lens.